Interest rates have hit their highest level in nearly 20 years. And if you've been watching my videos for any period of time, you know I was completely wrong about interest rates. Earlier in the year, I said I didn't think interest rates would go above 4%. And then I also said I didn't think they would go above 5%. And then I thought the peak was at 6.25%, and here we are today sitting around 7% with regards to a 30-year fixed interest rate. So I'm not going to sit here and make excuses as to why I was wrong about rates. Obviously, there's been a lot of things that have happened in the economy, like Ukraine and Russia, and just some unforeseen things like inflation continuing that I didn't predict. But the reality is, I was wrong. But the real question is, when will we see interest rates go back down? Will we see interest rates go back down, or will we see them continue to rise in the short run? We're currently at a crossroads with regards to interest rates. If interest rates continue to rise, I believe that could ultimately crush housing prices. Whereas if interest rates pull back, that could cause some buyer demand to come back into the market, and that could cause house prices to move sideways, slightly even up if interest rates were to get back down below that 5% level. At the moment, home buyers are pessimistic. Why? Because housing affordability is at its worst level in nearly 37 years. And that's because interest rates have gone up so much over such a short period of time, while at the same time, house prices haven't really declined significantly enough to make those houses more affordable. Even though mortgage demand has plunged, house prices in most markets continue to move sideways slightly down, which is continuing to put a strain on affordability because interest rates have more than doubled, but home prices haven't come down to a level where it's made owning a home any less expensive. With that said, Fannie Mae has come out and said that they expect home prices to nosedive. But then when you read a little bit further into the article, they're expecting a 1.5% decline in 2023 on the average US home. Now, some homes out there in some markets that appreciated a lot, markets like Phoenix, markets like Boise, markets like San Jose, San Francisco, these markets that shot up 45, 50% over a short period of time, those markets are likely going to be impacted a little bit more because of that rapid appreciation, because of affordability in those markets. Home prices in those markets need to come down more significantly than the markets that only appreciated, 20, 25% over that short period of time. But even then, in those markets, it doesn't necessarily make those homes that much more affordable just because of where the price points are already. So what actually makes housing more affordable? Well, a couple of things. You either have to have home prices come down, or you have to have interest rates come down. Maybe it's a combination of the two, or you have to have wages go up. And all three of those are a possibility, but the likelihood of all of them happening at one time isn't realistic. But in today's video, I want to talk about what would cause interest rates to go down, because I believe interest rates going down will have the biggest impact on affordability. Now, I don't currently believe that housing prices are going to crash. Like I've said in other videos, I think you could see a 5-10% decline in some of the really frothy markets that were out there over the last couple of years, but most markets are probably going to remain pretty stable. But if interest rates stay where they are, then those homes aren't any more affordable, as I mentioned earlier. So let's take some time here and actually talk about what would need to happen in order for interest rates to come back down. And the very first thing is lower inflation. As we know, inflation is the Fed's top priority. As inflation numbers come out and the numbers are higher than expected, the Fed has to get more aggressive. And as the numbers come out, the Fed looks at that and goes, okay, what we're doing maybe isn't working. We need to get more aggressive. And in turn, they raise the Fed funds rate. And as you can see historically, interest rates tend to follow inflation. As inflation goes up, so do interest rates. So long as inflation stays high, you're likely to see interest rates stay high. While they're not directly correlated to the Fed hiking the Fed funds rate, the 10-year Treasury tends to follow the Fed funds rate and mortgage-backed securities, and in turn, interest rates tend to follow the 10-year as well. So as the fund gets aggressive on the Fed funds hikes, that is causing interest rates to go up. But what if the Fed stops the Fed funds hikes because of lower inflation readings? And you might say, how is that going to happen? Well, the October, November, and December reads on inflation are actually quite a bit higher than anything we saw in 2021.
Here's the good news. Starting with the October 22 report, which we'll be receiving November 10th, that is going to begin a string of reports that will be replacing much higher numbers here, as you could see. As we go into the fourth quarter of 2022, we were replacing fourth quarter of 2021. And even in the first half of 2023, as we replace these 2022 numbers, which are higher readings, we have a really good chance to see inflation decline, and decline by a significant amount.
And so when the new reading comes out in November, on November 10th, that number is likely to go down, which is going to show inflation is actually going down and what the Fed is doing is actually working. And this could cause the Fed to pause a little bit. Instead of getting higher month-over-month readings, they're actually going to see numbers come back, which in turn may give them an opportunity to pause and reassess as new readings come out, and hopefully those inflation numbers continue to subside. And if they subside, then the Fed will stop hiking the Fed funds rate, which in theory means less volatility in the market, and interest rates could pause and interest rates could move back downward. Now, I don't expect interest rates to reach the lows that we saw around 3.5%. I think if interest rates were to pull back into the mid fives, even 5%, that would help stimulate some buyer demand out there. All those sellers that are sitting on the fence, that have 3% interest rates locked in, that are looking at the market now going, I won't sell because interest rates have more than doubled from what I have now. They're not really happy in their home, but they'd like to move if it made sense. I think if interest rates pulled back in the 5% range, you could see some of those sellers, even though they're paying more, make the move because maybe they need to for reasons like their family's growing or whatever. And it, while it doesn't make sense at interest rates near 7%, it might make sense to them with interest rates around 5%. On top of that, the second thing that could cause interest rates to come down, higher unemployment. Now, there's a lot of people out there that comment on my videos and keep saying, hey, wait till the unemployment rises. That's what's going to crush housing because these people are going to lose their jobs. There's going to be foreclosures. There's going to be a housing crash, so on and so forth. Well, understand, one of the measures that the Fed uses to hike the Fed funds rate is unemployment. And unemployment has stayed really, really low. In fact, we're sitting at all-time unemployment currently around 3.5%. And that's given the Fed the green light to continue to do these Fed fund hikes. But if they started to see unemployment numbers rise, that likely means a recession is on the way. Now, a lot of people believe we're already in a recession, but that could tell them that, hey, maybe we're going too far. Unemployment's rising. We need to stop. We need to pause what we're doing with regards to quantitative tightening. And in turn, that would allow interest rates to breathe and potentially move downward. And the third thing is less volatility overall. Part of the craziness in the market, why you see these big swings up and down, like we did with the latest CPI reading, the market was down substantially. At the end of the day, we ended up, is because of expectations on these readings. Well, if the expectations actually end up being less than what the market's predicting, that means less volatility in the market. If the Fed follows through and does what they say they're going to do versus going off course, that creates less volatility in the market. And less volatility typically means less volatility in interest rates, which could allow rates to move down. And the last thing we're going to talk about is a recession. Everybody says we're in a recession, we're headed into a recession, unemployment is going to rise, we're going into a recession. Whatever you believe, if you believe a recession is here, we're headed into one, recessions are deflationary by nature, which means they bring inflation down naturally. On top of the Fed hiking the Fed funds rate and doing all this quantitative tightening, and at the end of the day, we know that interest rates follow inflation. So if inflation comes down, interest rates are also likely to come down. At the same time, recessions are when the economy is slowing. There's less growth out there. And during those times, the Fed is typically trying to get more growth in the economy. And how they do that is by quantitative easing. Now, I don't think they're necessarily going to start lowering the Fed funds rate or buying mortgage-backed securities to help stimulate the market. But what I do know is that if we truly are headed for difficult times in the economy, the Fed is likely going to back off their current stance, which is going to allow interest rates to go down. But I'd love to know your thoughts. Where do you think the market is headed at the moment? Where do you think interest rates are going? Let me know in the comments below. Now I want to mention something I mentioned earlier in the video. We're at this crossroads where if interest rates continue to rise, house prices are likely to get crushed in many markets out there. Now, what do I mean by crushed? I mean down 5-10% in some markets out there. Not crashing, just going down. But at the same time, if interest rates go down, that could spur some buyer demand, and that could cause housing to continue to move forward just because of the lack of supply currently in the market.